There's a specific kind of torture that crypto investors have invented for themselves. It doesn't involve bad trades. It doesn't involve missing a big move. It doesn't even involve losing money, at least not directly. It involves opening an app, looking at a number, closing the app, feeling something, opening the app again 12 minutes later to see if the number changed, and repeat all day, every day. Sometimes through dinner, sometimes at 11 p.m. when you should be sleeping. Sometimes in the middle of a conversation with someone you care about, phone face down on the table, but your brain is somewhere else entirely. If you own crypto, you know exactly what I'm talking about. And if you're being honest with yourself, you probably checked your portfolio at least once before you started watching this video. Here's the thing, nobody tells you about that habit. It's not keeping you informed. It's not making you a better investor. It's not reducing your risk or improving your timing or giving you any kind of edge. It's actively making you poorer. And the mechanism behind why is one of the most fascinating and uncomfortable things I've come across in studying how people actually build and destroy wealth. Today we're getting into the neuroscience of portfolio checking, what it does to your brain, what it costs your account, and what the relationship with your portfolio actually looks like for people who are quietly, consistently building wealth. Let's start with why the habit feels so reasonable. When you check your portfolio frequently, it doesn't feel like a problem. It feels like responsibility. It feels like staying on top of things. In most areas of life, your business, your health, your relationships, paying close attention is a virtue. The people who check in, who monitor, who stay engaged, tend to do better than the people who ignore things and hope for the best. So the logic transfers naturally. If I'm watching my crypto portfolio closely, I'll catch problems early. I'll know when to act. I'll be ready when something important happens. That logic is completely understandable. It's also completely wrong in this specific context. And the reason comes down to something that most financial content never talks about: what frequent observation actually does to the quality of your decision making over time. Here's what's actually happening every time you open that app. Your brain processes gains and losses asymmetrically. This isn't a personality quirk or a matter of discipline. It's hardwired neuroscience, and it operates in every human being regardless of how smart or experienced they are. The research, most famously from behavioral economists Daniel Kahneman and Amos Tversky, shows that the psychological pain of losing a given amount of money is roughly twice as powerful as the pleasure of gaining the same amount. Lose $500 and gain $500 in the same day, and you don't feel neutral. You feel net negative. The loss hit harder. It always does. Now, think about what happens when you check your portfolio once an hour across a volatile crypto market. In any given hour, your portfolio is either up or down, sometimes significantly, sometimes both within the same 60 minutes. Each time you check and it's down even a little, even temporarily, your brain registers that as a genuine threat. Cortisol gets released. Your stress response activates. The rational, long-term thinking part of your brain partially goes offline. And because losses feel twice as bad as gains feel good, a day with 5 up checks and 5 down checks doesn't feel neutral. It feels like a net loss. Even if your portfolio ended the day higher than it started, this is called myopic loss aversion, and it is one of the most expensive cognitive patterns that exists in investing. The research on this is striking. Studies have shown that investors who receive frequent feedback on their portfolio, checking daily or multiple times per day, consistently make worse decisions and achieve lower returns than investors who check infrequently. Not because the frequent checkers are less intelligent, because the frequency of observation is frequency of emotional exposure, and emotional exposure degrades decision quality. Every time you check and the number is red, your brain nudges you, sometimes subtly, sometimes overwhelmingly, toward the action that would make the bad feeling stop. And in crypto, the action that makes the bad feeling stop is selling. Here's where the math starts to get genuinely uncomfortable. Most people who overcheck their portfolios don't make one catastrophic decision. They make dozens of small, suboptimal ones. And the compound cost of those micro decisions, the early sells, the panic trims, the just reduce exposure a bit moves at exactly the wrong moment, is something that almost never shows up in how people analyze their own performance. Think about it this way. You buy Bitcoin at $60,000. Over the next 3 months, it fluctuates down to $52,000, back up to $64,000, down to $55,000, up to $71,000 throughout this period. If you're checking hourly, you're experiencing that emotional roller coaster in real time. Every dip registers as a threat. Every recovery registers as relief, but not quite as much relief as the dip hurt. So you start making adjustments. Maybe at $52,000, you sell 20% because you can't take the stress anymore and you tell yourself you'll buy back lower. Then it recovers to $64,000 before you buy back, so you buy less than you sold. Then it drops to $55,000 and you do it again. Slightly different amounts. Slightly different prices. Each decision feeling totally rational in the moment, each one based on the emotional state created by watching every hourly move. By the time price hits $71,000, you own meaningfully less than you did at $60,000. Not because of one bad decision, because of a dozen reasonable feeling small ones, each of which was triggered not by new information or changed fundamentals, but by the emotional interference generated by checking too often. Now multiply that across every asset in your portfolio, across every week of a year, across multiple years of the same pattern. That's not a trading problem. That's a wealth destruction pattern that's completely invisible because no single decision looks catastrophic in isolation. The damage only becomes visible when you step back and ask, where would I be if I'd bought and checked monthly instead of hourly? The answer in most cases is significantly wealthier. Here's the part most people never examine. Why does checking feel so necessary even when it doesn't actually help? The answer is that checking feels like control. And the human brain craves the feeling of control, especially in situations of genuine uncertainty. Crypto markets are deeply uncertain. Prices move for reasons that are often opaque, sometimes irrational, and frequently driven by forces completely outside your influence. That uncertainty is uncomfortable. And one of the brain's favorite strategies for managing the discomfort of uncertainty is to gather more information, to monitor more closely, to stay on top of things. The problem is that in this particular context, more information doesn't reduce uncertainty. The price of Bitcoin in the next hour is not more predictable because you watch the last 6 hours closely. Your stress response doesn't know that. It just knows that watching feels better than not watching. Active feels better than passive. Checking feels better than trusting. So you check. Not because checking helps, because not checking feels like the irresponsible thing to do. This is the illusion. The sense of control that comes from constant monitoring is entirely psychological. It changes nothing about the market. It changes nothing about the fundamental value of what you own. What it does change significantly is the quality of your decisions and the emotional cost of holding your positions. And here's something that should stop you cold. The people who have built the most wealth in crypto over the last decade are overwhelmingly not the ones who watched every hourly candle. They're the ones who had a thesis, allocated accordingly, and checked infrequently enough that the short-term noise never got loud enough to shake them out of their positions. The irony is brutal. The behavior that feels most like responsible investing is one of the biggest obstacles to it. Let's get specific about what's happening physiologically when you're deep in a heavy checking cycle, because this is something nobody puts in the thumbnail, and it explains a lot. Your amygdala, the threat detection center of your brain, does not distinguish between a genuine physical threat and a financial loss. Both trigger the same stress response. Both release cortisol and adrenaline. Both activate the fight or flight system. That system was designed for short bursts. You see a predator, you sprint, the threat passes, your body recovers, the whole cycle takes a few minutes. But when you're checking your crypto portfolio 10, 15, 20 times a day during a volatile period, you're activating that stress response repeatedly without ever giving your system time to recover. You're dripping cortisol into your bloodstream across an entire day. And chronically elevated cortisol does something very specific and very relevant to your ability to make financial decisions. It impairs the function of the prefrontal cortex. The prefrontal cortex is where long-term thinking happens, where risk evaluation happens, where you access your actual investment thesis and remember why you bought something in the first place. When cortisol is chronically elevated, that function degrades. You become more reactive, more short-term focused, more susceptible to the immediate emotional state overriding the longer-term rational plan. In other words, the more you check during a stressful market period, the less capable you become of making the kind of calm, thesis-driven decisions that produce good outcomes. You are physiologically degrading your own judgment with every refresh, and the 10th check of the day doesn't come with a warning label that says your decision-making capacity is currently 40% below baseline. It feels like you're just staying informed. It feels like the same you making the same quality decisions you always make. That's what makes this so expensive. The impairment is invisible from the inside. Here's where things get encouraging, because the fix is simpler than almost anything else in investing. A study published in the Quarterly Journal of Economics, and this is one of those pieces of research that genuinely changes how you think about this, gave one group of investors monthly performance reports and another group annual reports. The group receiving monthly reports invested significantly more conservatively, took on less equity exposure, and earned meaningfully lower returns over the study period. Not because they were less sophisticated, because more frequent information meant more frequent loss exposure, which meant more frequent emotional interference with their allocation decisions. The investors who saw their portfolios less often were effectively shielded from the noise. They made fewer decisions. The decisions they made were less emotionally driven. Their outcomes were better. Now apply this to your crypto portfolio. If the fundamental question is how often should I actually check, here's an honest answer that most people aren't willing to accept at first. For a long-term crypto position that you've sized correctly and have genuine conviction in, once a week is plenty, maybe less. If your thesis is a 3 to 5 year view on Bitcoin or Ethereum, what is the hourly price telling you that you actually need to act on? Almost never anything. For an actively managed trading portfolio with defined entries and exits, check at the specific times relevant to your time frame. If you're trading daily candles, you don't need to monitor hourly. If you're trading weekly setups, you don't need to monitor daily. The checking frequency should match the actual decision frequency your strategy requires, nothing more. The question that clarifies this immediately is, what decision am I prepared to make based on what I see right now? If the answer is nothing, if checking is purely informational with no actionable threshold, then the check is costing you emotionally without giving you anything back. Let me describe a pattern that I'd be willing to bet sounds familiar to a meaningful percentage of people watching this. You buy a position you feel good about. The first few days, you check obsessively, partially excitement, partially the variable reward hit of watching something you own move. If it goes up, great, you check more. If it goes down, you feel the loss disproportionately and start questioning the thesis. Not because the thesis has changed, because the number changed. Then comes the first real dip, maybe 15%, maybe 25%. Crypto moves like that regularly, and none of it necessarily means anything about the long-term trajectory. But you've been checking hourly. You felt every step of the decline in real time. Your stress response has been accumulating for days, your prefrontal cortex is running below capacity, and the thesis that seemed so clear when you bought is now getting very hard to access emotionally. So you sell, or you trim, or you set a stop that gets triggered during a wick that recovers 5 minutes later. Then the price recovers, and you watch it recover from the sidelines in cash, feeling a completely different kind of terrible, the specific pain of having been right about the asset but wrong about your own behavior. This cycle, buy with conviction, erode conviction through constant monitoring, exit at a poor moment, watch the recovery, is the most common, most expensive, and most invisible way that crypto investors lose money. Not through picking bad assets, through not being able to hold good ones. And the root cause, the thing that starts the whole cascade, is checking too often. Here's what actually works. And I want to be clear that this isn't about willpower or discipline in the way most people think about those things, because if the problem is that checking creates emotional interference, then the solution isn't to check just as often but feel less. The solution is to structurally reduce the checking frequency so the emotional interference never gets generated in the first place. The most effective thing you can do right now is set a checking schedule and stick to it. Not hourly, not daily for a long-term position. Weekly. Put it in your calendar. Tuesday at 7 p.m., you look at your portfolio. That's it. The rest of the time, the app stays closed. Not because you're ignoring your investments, but because you've decided in advance that nothing that happens between Tuesday check-ins is going to meet the threshold for action that you've set. If that feels too extreme, here's a gentler version. Identify one specific condition under which you would genuinely act, not if it goes down I'll sell, because that's just the stress response making rules. A real condition. Something like, if this asset drops more than 30% from my entry, I want to reassess my thesis, set a price alert for that level, then close the app. You now have a rational system monitoring the condition that matters, and you don't need to watch the hourly fluctuations that don't. This is what a healthy relationship with your portfolio actually looks like. Not obsessive monitoring, not complete ignorance either. A predefined frequency of review tied to your actual investment horizon. A predefined condition for action that's based on your thesis, not your emotions. And a structural barrier closing the app, removing it from your home screen, turning off notifications that prevents the idle, anxiety-driven checking that generates emotional noise without producing any useful signal. There's a deeper shift underneath all of this that's worth naming directly. Most people who overcheck their portfolios have unconsciously adopted a trader's identity while following an investor's strategy. They bought a long-term position, but they're monitoring it with a trader's frequency. And those two things are completely incompatible. The monitoring frequency creates the emotional environment of active trading. Rapid fluctuations, constant decisions, wins and losses accumulating in real time, while the actual position is supposed to be a patient, thesis-driven hold. The shift that produces better outcomes is aligning your monitoring behavior with your actual strategy. If you're a long-term Bitcoin holder, you're not a trader checking charts. You're an investor reviewing a quarterly update. The app is not your Bloomberg terminal. It's a statement you read once a week on a schedule you chose in advance. That identity shift changes your relationship with volatility entirely. When you're not watching every hour, a 15% dip in Bitcoin is not a 12-hour emotional experience. It's a data point you encounter during your scheduled Tuesday review. Evaluate calmly against your thesis and either act on or don't. The same event. Completely different psychological impact. Completely different quality of decision. The investors who are quietly building real wealth in crypto, not the ones posting screenshots of a 3-day win, but the ones who've been in this for years and have something significant to show for it, almost universally describe a similar relationship with their portfolios. They don't watch it obsessively, they don't need to. They have a thesis, they have a position, and they've built a structure around that position that protects it from their own short-term emotional responses. That structure isn't complexity. It's mostly just deciding not to look until it's time to look. Before we close out, I want to address something directly because I know it's the objection that shows up the moment you start thinking about checking less. It feels irresponsible. Like if you're not watching, something will happen and you won't be ready. A rug pull, a regulatory event, a crash that you could have seen coming if you'd just been paying attention. Here's the honest answer to that. For genuine black swan events, the kind of catastrophic, rapid moves that actually require immediate action, price alerts exist. You can set an alert for any meaningful threshold and your phone will notify you without you needing to actively check. That's a tool designed precisely for this concern, and it does the job better than obsessive monitoring does because it's triggered by the condition that matters instead of by your anxiety. And for the events you'd catch by watching closely, the gradual moves, the slow deterioration, the things you might see developing over days or weeks, your weekly review will catch those too. The check every hour version of you and the check every week version of you will both see a 40% drawdown developing. The only difference is that the check every hour version of you will have been emotionally degraded by days of accumulated stress by the time they make the decision, while the check every week version is making the same decision from a clear head. More monitoring does not produce better decisions in a volatile market. It produces more decisions, made from a more compromised emotional state based on information that mostly doesn't require a decision. The portfolio isn't the problem. The relationship with the portfolio is. Here's what I want you to take away from this. The number of times you check your portfolio is not a measure of how seriously you take your investments. It's a measure of how much emotional interference you're generating between yourself and the outcomes you're trying to build. Start with one change this week. Pick a checking schedule that matches your actual investment horizon and stick to it. Long-term holder, Tuesday evenings. Active trader, once at the open, once at the close. Set one price alert for the level that would genuinely require action. Then close the app, not because the market isn't worth watching, because your decisions are worth protecting. And the easiest way to protect your decision quality is to stop exposing it to noise that was never going to change what you do anyway. The portfolio doesn't need your attention every hour. It needs your judgment at the moments that actually matter. Build the structure that protects both.